Everybody, thank you for having me. My perspective is from the primarily from the carrier perspective, even though at DAT we look after brokers, carriers and shippers. My background is all in trucking. Did a few million miles as an over-the-road driver in Australia, still involved in the family livestock haulage business in the outback, still own a Peterbilt with a, am I allowed to say Caterpillar engine here? So I still own a truck and still drive on the weekends. So I'm still active in the industry. But my day job is a freight market analyst for DAT. So they're primarily a load board and rating engine company. We see about 2.5 million truckloads a week on our spot market load board. We've got about 150,000 carriers in our freight network. Most of our contributions on our rate side come in overnight. Half of them are in before loads are delivered. So a lot of our data comes in based on loads moved. So the data I'm going to show you is based on loads that are moved by carriers, not based on rates posted by brokers on load boards. And there's a huge difference in the two. So there's a lot of the data I'll show you will be some of the national averages. So I want to start off with a data point that we've been developing to get some sense of is capacity growing or decreasing or declining. So what we've done, we pull the FMCSA data from the database every day, like I'm sure some of you already do. One of the challenges with the database is it's lagged. It takes a lot of time for carriers to come on and go off, so there's a little bit of cleanliness with the data that we try and work on a timely basis. But the data point I wanted to share with you is that when you look at the green line on the chart, the green line are new DOT authorities and reactivated DOT authorities. So you need a DOT number for anything over 10,000 pounds GBW. You've got to get a DOT number. The data point that's always surprising to me is no matter what time of the industry we're looking at, there's always carriers leaving, there's always carriers coming. And the net has been, up until the pandemic, we were adding about 1,000 net new carriers a month. So the industry was growing in capacity. There were more trucks, about 1,000 net new carriers. The caveat I want to impress upon you is this is for everything from a straight truck, a box truck, an expediter, to a Class 8 tractor trailer. So some people in the media portray this data as primarily Class 8 tractor trailer over the road data. If you read between the lines the way they write, it's not. It's very misleading to think that. This is everything in the industry. Now, what I've done here, because DAT is a longer haul business, I've just looked at in this chart interstate. So I haven't included all the intra-state box trucks and final mile carriers in this data, with the exception of two states, California and Texas, because you can do long haul intrastate in both those states. So this data here is for all carriers interstate, but including California and Texas intrastate. I hadn't had a chance to get the intrastate version of this together for today, but what you can see is right up until, or you can see that first big dip in 19, that was when we had record bankruptcies in that second quarter. So you saw a net loss of carriers, understandably. But by the time we got to PPP loans ending in July of 2020, there was a massive influx starting. It coincided with spot rates increasing and diesel prices dropping. And what you had in that second half of 2020 was an incredible period of profitability for all of these new carriers that entered the spot market. And the majority of them entered DAT's load board network when we tracked them. The chart that we have for our network adds and subtractions is identical to this. It's the same pattern. If we were adding 1,000 net new carriers for up until, from 2014 all the way to mid-2020, by the time we got into the pandemic, we added nearly 8,000 net new carriers in the middle of 2021 in one of those months alone. So we are still seeing the tail end effect of that now with excess capacity in the market, in particular the spot market. The second data point is, as of October, November last year, it went negative. We started to lose capacity in the long haul sector. It went negative, and it's been negative at the rate of about 2,500 carriers leaving the industry every month. So the net is 2,500 less carriers. That's the black line on the bottom. It went negative October, November. What is interesting, in the first 3 weeks of February, the direction has changed. We've only lost 1,100 carriers as opposed to close to 3,000 in our worst month. which was January. So you could infer from that chart that the tide has turned, fewer carriers are leaving than before, and at some point capacity will bleed off, especially in the smaller fleet, and will turn back to positive. And that kind of signals the bottoming out of the spot market and the beginning of the next inflationary phase in both spot rates and capacity tightening. So that's where we're at in the market. Now, does anybody have any questions on that? Because this is an important chart that I'll start to publish, and you can reference each month and get a feel for where we're going directionally. I think it's more directionally you want to watch these numbers as opposed to the raw numbers, but that's sort of directionally where we're headed. All right. So, sorry, Jeff? No, exactly. So that's why I put 3 months in there and said it's, we're not quite there yet. So this changes daily, but it's interesting. For the first 3 weeks, that direction's all been up on that black line. So, but you're right. We need to see what February looks like, and we'll know that shortly. All right. So in the context of that chart, this one explains what we've been seeing in the spot and contract market since 2010. The blue line is contract rates. This is line haul excluding fuel surcharge. And the red line is spot rates excluding fuel surcharge. First thing you'll notice is that there's a lot more volatility in the spot market. And we can see the 2014-15 period there. Spot rates went up. We had a freight recession in 16. Then we had the 2018 period. And then we went into that next sort of freight recession in 2019. We were still losing capacity right up until the pandemic started. When you look at the net number of adds and subtractions, the industry was still shedding capacity this time in 2020. And that's when things changed. You can see that massive drop in the red line. The data point that I think is the most interesting here is both the amplitude of the cycles is changing, and so is the duration. So it means the amplitude is getting higher, but the duration is getting shorter. And there's a couple of reasons we could point to about why that's going on. Obviously, the pandemic is the big one. You could almost say some of those data points are outliers, and we should throw them away because they're not representative of past cycles. But what's happened since 2010 is that the cycles have got have a lot more volatility to them, and they're shortening. And I think Mazen had a great point last night that, even though I said our current cycle, we're only like a year into the current spot rate decline and it's starting to bottom out, he thought there was some hangover effects, right, maybe it was been going on for a little bit longer than the year. And I think that's a valid point. But it's not your typical 18 months to 3 year cycle. We're much shorter in our cycles. One of the data points we see in our load board is transparency and industry visibility. There's a lot more carriers have all of the freight market on an app. And it's just like, this is the difference between getting your stock prices on the Wall Street Journal paper version versus your app. More information in the market makes the markets go faster, transactionally more faster. And that's what we're seeing from carriers. They're more nimble, they can move in markets more quickly because they can see all of the data on the end of their hand, essentially. So that's where we sit right now. Spot rates at 233 excluding fuel, still historically high. They were a little bit high. I'll cover the year-over-year comps a bit later, but that's sort of where we sit coming out of the pandemic. Big question is, do we revert back to more normal trends? The data point here is early seasons, market sort of cycles back in the early 2010 to 2015 period, you'd go up 5%, down 5%. And then we got to 2018, you'd go up 20%, and you'd go down 20% in your year-over-year comps. Last year, 2021, spot rates went up 70%, and they're now still heading down around 40% year over year. So the year-over-year comps have become far more extreme when we look at them. So we don't know if that trend is going to continue in the next cycle that we see starting to bottom out and reappear. So let's dive into some of the spot rates to frame what we're seeing. Remember, we're seeing about 150 billion in freight transactions every year. It's about 80 billion of that is spot. And the rest is contract freight. So the vast majority is spot, vast majority of it comes from brokers every night. This is the year-over-year view, and you can see spot rates in line haul in dry van are tracking that blue line, which is 2018. And a lot of our spot market demand triggers look like 2018 did, which was a good year. It was primarily a flatbed driven rate rally, a lot of industrial economy stimulus, changes in the tax code, oil price rally, really good year for carriers. You can see seasonally we're tracking down with other years, but we're still about 91 cents a mile lower than the purple line, which was last year. And the red line, of course, you can see we're coming up on the anniversary of the polar vortex, which was that red line and the massive capacity crunch that we had there through the Midwest all the way down into Texas. The orange line is the pandemic, and you can see that we just had so much volatility in the last 3 years. It's very hard to pick a year and say this is what 2023 looks like. It looks and feels the most like 2018 did from a demand perspective in the spot market. Supply is a different story. If I look at the number of trucks looking for loads on our load boards as a proxy for supply, it matches 2019 levels, which was not a good year for carriers. It was an oversupplied market, more carriers. And you've already heard today that we have, capacity is overshooting demand significantly at the moment because of that sort of bullwhip effect from all of those carriers entering the market in 2021. All right, so this is refrigerated, very similar chart. These are the year-over-year comps. Remember, line haul excluding fuel. These are based on loads moved. National average is 204, excluding fuel. It's $1.03 per mile lower than this time last year. So these are national averages. We have a saying that no one's home at the average, right? Because there's the outliers are where you see the variability. If you're running out of Seattle to Los Angeles today, you're getting 90 cents a mile south, but you're getting 240 running north. So when you put it all together as a national average, it comes out at 204. But if I'm hauling produce out of Fresno today, I'm probably running at $4 a mile from Fresno to Boston. So just be careful that when you think about national averages, it doesn't apply to everybody because a lot of the real money for carriers and brokers is regional. So that's where we sit with reefer. Dry van reefer, very similar. Flatbed, totally different story. Rates have been going up for the last 3 or 4 weeks. It's a very strong market. Even though volumes are way down, we are seeing a third of the load post volumes we were this time last year at the peak of sort of the housing boom market. A third less. But surprisingly, and I think this has got a lot to do with Robert's business, it's such a specialised business, flatbed. You can't interchange like a dry van and reefer can between produce and dry freight. Flatbeds like flatbed specialised. Those rates are going up and have gone up for the last 4 weeks, which has caught a lot of us by surprise. We thought it would be a long, hard winter. Spot rates for flatbed carriers have started to go up, even though they plateaued last week, at about $2.13 a mile. So you'd have to add the fuel surcharge onto that to get the all-in rate. Flatbed rates are about 7 cents a mile higher than 2018 and 2019, right, to give you a sense of where they sit right now. And I think this is my last slide. So this is the contract freight market. This is the other 60 to 70 billion of freight spend we see. So active rates are the collection or the sum total of all of the rates in routing guides within TMS systems that are being used every day on repetitive loads based on a negotiation that happened last year. So these are fixed rates that are used over and over and over. They're called the active rates. It's the average of all of the rates in the routing guides. Down about 0.5%. This is sort of month-over-month numbers. Replacement rates, though, are rates negotiated by carriers and shippers on an RFP in the last quarter of last year. And RFP negotiated rates are trending downwards. Shippers are rebidding their lanes, and that has been trending down slowly. So the active rates are decreasing stubbornly slow, right? But the new rates coming in are 11% lower for the incumbent carriers, 9% lower for temp control, 5% lower for flatbed, and about 4% lower for intermodal. The big difference this year is we've seen a lot more carrier discipline in the RFPs. Carriers, we've all got much higher operating costs. My truck's up 30 cents a mile, my operating costs, my Class 8 truck year over year. I think every single carrier has had higher operating costs. It's created a new floor price. So that's why we don't think we'll see 2019 rates, because the floor price to run a truck is much higher this time around because of mostly diesel, but also higher wage costs that you can't claw back. A couple of trends you should think about. Spot rates lead contract rates by 4 to 6 months. If we're seeing spot rates bottom out now in March, sort of you think March is the bottom, sometime around September, October, we expect the inflection point on contract rates to start moving up again, to start increasing. That's typically how the cycle moved. Spot rates dropped in January last year. In August, contract rates started to turn south. So there's always a lag between the two, and we're following that cycle. It looks like half one will be a turning point for the freight market. That should coincide with spot rates starting to increase. Capacity should have exited the market by then. If the trade cycles continue because the trucks are coming out of factories, if the average age of the fleet starts to decrease and trade cycles start to send more used trucks into the used truck market, used truck prices should come down, and then more carriers should enter the market in the spot market, and we're off into the next cycle in the second half of this year. That's how it's kind of playing out now. One thing I'll end with, there's a couple of things that are very different this year around with contract shippers that we haven't seen before. They have memories of elephants, right? And they realised that last year they lost a lot of capacity. They didn't necessarily have all the trucks they needed. What they've done in the last RFP is stick with their incumbent carriers, award them more volume in exchange for lower rates, which can mean more profitability from better lane density, right? So both parties win. But instead of sending, we looked at all the RFPs, instead of sending the RFP out to every carrier, they only sent the RFP out to a select few, and only on mostly about 20% of their lanes. Because in the contract shipper world, 80% of the volume moves on 20% of the lanes. So instead of sending out an RFP for 100% of your lanes, they were taking the low volume lanes and sending them direct to the broker market rather than through a routing guide. Why is that significant? If you put a low volume lane into a routing guide and everyone rejects it, you end up in the spot market, but you create a service failure, a tender rejection. So what shippers said this time around is let's engineer out those failure points, send the volume for the low volume lanes direct to the spot market, and we can manage our spot market buy much better if we do it strategically. As opposed to the day of when everybody said no to the load and you're left with the 6 o'clock truck to run to Denver this evening, and you've got to pay whatever the market's going to be at that time. So they're the two things that are happening. They stuck with their incumbent carriers, gave them more volume, but they're sending more low volume lanes direct to the spot market. And that is a fundamental shift which will alter the market timing of the cycles, because shippers are sending more volume to the spot market. Even though the total pie is decreasing, there's more volume. We're still seeing about 20% of our volume move on spot in our network. And it stayed about 20% most of last year. It was 13% in 2019. It was 22% in 2018. But it stayed there. Even though the demand is flattening and there's signs of it cooling, we're still seeing more volume in spot than we would have normally seen. I'm going to pause there and hand it over.
So I'm Travis Dietrich. I'm with B&B. Figured I'd start with my family. We are a family-owned and operated company. And you'll see 3 of my 14 children I have there. My 2 boys, and then we have 5 horses, 3 dogs, 4 cats, and then my lovely wife, who has brought all 14 of these lovely animals into our house. I'm a farm kid from Minnesota. Yes, it is 2 O's and 1 N. That's how we pronounce it in Minnesota. So my history really goes back to that. I started driving semi-truck, I think the first time I was 12. I took grain to the local elevator. And so just to give you an idea of really B&B and kind of what we do, that's kind of where our roots really come from. It's a lot of farm kids, and that's where the company started back in 1941. Cargill was our first customer, and it's B&B from 2 Bay Mare horses. That was the original horsepower of the company. So I thought the horse being there would be fitting. So my responsibilities within the company currently, I oversee our refrigerated logistics side. I also oversee the power-only owned authority fleet. So that's going out and finding outside carriers to haul our trailers. In regards to the company itself, we currently have a little over 500 trucks on the road. We are 100% refrigerated. We run about a 1.8 truck to trailer ratio, so obviously much lower than what the trailer manufacturer was talking about earlier. But that's changing, and I think that's changing across the entire industry. Customers are asking more and more for having more trailers. Drop trailers becoming critical. Just when you look at the amount of staffing that people have. When you look at these warehouses where they're located, trailers are needed, and there's no warehouse space. The one thing that I've been working with a lot of shippers on recently is using our trailers for that storage aspect. And so just in regards to when I look at kind of the industry and where we're going, you know, I've listened to a lot of the folks today and yesterday. It's what drives me nuts about this industry. We continually do this to ourselves, but it's also what I think what keeps everybody in the industry. Overall, the industry is strong, but you are going to see, you know, Dean brought up the failure rate, and you brought up 1 month is not a trend. It's going to get ugly. The reality is the cost of trucks, when you look at the majority of trucking companies, they are less than 10 trucks total. On the logistics side, that's a lot of the guys that we're working with. Everybody was fat with cash, and so everybody went and bought new trucks, new trailers, and they cannot afford to run at these current rates. We actually have one of our own B&B drivers down in Texas, longtime driver. He quit because he could make the same amount of money being a construction worker. And so at some point, the construction is going to go down, and I would imagine we'll get that driver back. But you're seeing a lot of that kind of throughout the industry. And so, you know, I'll kind of save the rest of my comments for the Q&A aspect. But overall, like I said, B&B, we did about over $200 million in logistics last year, 500 trucks, and then we have a few additional acquisitions that we're actively going to be moving forward with overall. We used to be dry van. Back in 2016, we made a full conversion to refrigerated, and I think that's my final point here, and I think it's fitting with what was talked about. In 2009, if everybody remembers what 2009 was like, the previous carrier that I was actually overseeing, we went out of business 4 days before Christmas. B&B at that time had refrigerated, and they had dry van. Dry van was the largest sector of our business. Our rates on the dry van sector plummeted. And the refrigerated side, they stayed fairly flat. They went down, but not horrible. And so we made the strategic decision that we were going to get out of the dry van space and go full refrigerated. As a 500 truck fleet, we're meaningful in the refrigerated space. 500 trucks in a dry van, we're kind of a nothing at that point. And so, you know, as you kind of start looking out there and you look at the different carriers and what's going to happen, I think those carriers going out of business, because again, it's going to be the smaller carriers. That's going to be kind of when you'll see the change in the dynamic. We are seeing our recruiting efforts change. We're seeing more and more drivers come with experience, better drivers coming lately from carriers who either aren't doing as well or they're starting to struggle. So I'm more in agreement that 2023 is probably going to be more a long haul in 24 overall, but everybody has their own opinions, right? So anyway, thank you, and look forward to all your questions.
Good afternoon, everybody. Again, my name is Scott Doback, and I am the president and CEO of Grammer Logistics. As Tim had mentioned, our corporate headquarters are right here in Columbus, Indiana. And just for edification's sake, Grammer is a very small town right next to Columbus, Indiana. And the business was founded by the Whittington family, who grew up in Grammer, Indiana. And so that's how the name came about around the business itself. As Tim had mentioned also, I've spent my entire career in transportation logistics. 38 years tells you how old I am getting, but it has just been a great career. I've enjoyed it tremendously. The first 20 years were with an asset-based, publicly traded company, and the second half of my career has been all on the private equity side, private equity-owned businesses, which Grammer is today. But just quickly about the business, just to give you a feel, this is a little bit more of a niche business. You know, Dean talked a lot about what's going on the rate side of the business and the capacity side. Grammer, because of this products that we haul and the equipment that we have, sometimes good, sometimes bad. We don't play as much into that spot market, open market type of scenario that you're seeing so much that, Dean walked through. Our business ourselves, just from a revenue standpoint, just over $115 million in 2022, a little over $20 million of EBITDA for the year. The numbers on the fleet are a little bit underinflated. Today we have about 550 drivers. Each week we're growing that because the capacity demand is such. Our trailer fleet today sits at about 825 trailers. We haul primarily two different type of trailers. One is called a 331, which is a pressurized tank, primarily for the ammonias market and also for the NGL markets. Primarily we haul butane and propane, but we will get into some other NGL markets as well. And then the rest of our fleet is what's called a 407, which is a specialty chemical trailer. They're the ones you see going down the road, kind of the shiny tanks that you see going down the road. And that's the rest of the fleet. And I'll kind of explain how this has all evolved over time. We are owned by a private equity group by the name of Stellex. Stellex bought the business back in October of 2018. So using a baseball analogy, we're kind of in the 8th inning of Stellex's ownership, and I'll talk a little bit about what that means around our strategy and what we're doing with the business itself. But as I mentioned in my opening comments, we really focus on some key areas. The business was started by the Whittington family in the ammonias market, being out here in a very heavy agricultural area, primarily ag ammonia is how the business was started. Then they transitioned the business just from ag ammonia, also getting into industrial ammonias, which we still do today. And on a future slide, I'll kind of show what percentage of our overall business that represents. Right at the end of the Whittington family ownership, they slowly were getting into the NGL markets, because the NGL markets can use the same equipment that you can use in the ammonia markets. And the way there's so much seasonality in the ammonia markets, they wanted to obviously try to utilize that fleet as much as possible. And so they started getting into the NGL markets right before they sold the business. And so under Stellex's ownership, again, they bought the business back in October of 18. They went out right away in 2019 and bought a large NGL carrier by the name of Sterling Transportation out of North Carolina. Basically doubled the size of the company, doubled the size of the fleet, but now we were starting to haul NGL products along with ammonia products at the same time, but you still had seasonality in both of those business sectors. So from there, Stellex started to, I don't want to say professionalize, but upgrade the management team, and we brought a new COO in, a gentleman by the name of James Witten, who came out of the specialty chemical markets. So Grammer had not handled anything in the specialty chemical markets until 2021. So James's background in there, that's when we invested and started buying 407 trailers. And the whole strategy around that was not just top line growth, but it was also to try to mitigate some of the seasonality you had between NGL and the ammonia markets and get some stability in it. A little bit of a lower barrier to entry, and anybody who's been involved in private equity, one of the real things we really look for is try to focus on niche businesses with kind of a high wall or entry to barrier to entry into the market. You don't get as much of that in the specialty chemical markets, but you have a tremendous opportunity for growth, and you have, like I said, a little bit less seasonality in the business. So we've taken that business, which I'll show on a future slide as well, from just a startup in 2021, finishing 2022 at just over $18 million of our total business. And just, again, I've kind of got into some of the history, got ahead of myself, but you can see, kind of all the various iterations of the business. But where we primarily focus at Grammer is east of the Mississippi. We are not playing in the Western markets, but there are spot opportunities all the time with a lot of our major customers who will ask us to run different areas. We have trucks right now in Colorado. We have trucks up in the Pacific Northwest doing sometimes 3 months, 6 months spot contracts to be able to run and meet capacity needs of our customers. We've also started to transition some of the business from a management standpoint away from Columbus, and we've opened a second office down in the Woodlands in Houston, Texas, because so much of our growth is in the specialty chemical market and the NGL markets, and a lot of our customer base is down in that area. And more of the density that we're hauling right now are in the Texas, both West Texas, East Texas, and then obviously on the chemical side, very heavy in Louisiana. So I spend most of my time either in Houston or up here or just traveling to one of our terminals or meeting with customers. But we're seeing a lot of growth through down Houston, putting more and more people down there as a company. As I mentioned before, a split of, you can see where our business is at. The real challenge, and I should have backed up and said, I've only been with the business now, I'm starting my 7th month with the business. Stellex continues to make changes to try to hone the management team. And one of the things we really have been focused on, and quite honestly, if you want to call it for what it is, the frustration that Stellex has had with this business has been the lack of growth, but it's not because we don't have customers. The real challenge, where I really think it fits for this conference, is the fact we have been very challenged on the capacity side. And a lot of that was due to the pandemic, the ability of everything that was going on from a supply chain standpoint. But every year, the demand that we had from our customers, primarily in the ammonia markets and definitely in the NGL markets, we could not meet our customers' demand because I either could not find, or prior to my arrival, could not find a driver, or we could not find the equipment to haul it, primarily the tanks, the 331s, and then the 407s. We just could not get enough of them. And so going into 2023, we had an aggressive AOP, or annual budget, to grow the business. But then slots for the manufacturing side really started to open up in the 4th quarter of 2022, last year. And so for the first time in 4 years, we're going to be buying the 331 pressurized tanks. We're going to be bringing 20 of those on. A very expensive piece of equipment, run about $180,000 a unit, and that kind of gives you that high barrier to entry because it's a very specialized piece of equipment and not a lot of players in that market. So it allows for some rate stability and some, fairly decent margins in that business. The plan originally was to bring on 50 of the 407 trailers, and then as I mentioned in the 4th quarter, all of a sudden slots started to open up a little bit. Our primary manufacturers right now are Brenner and Polar. Both came to us saying that they had additional slots if we wanted them. That obviously makes you start to think, is the specialty chemical market starting to slow down, that all of a sudden slots are opening up and other competitors are not wanting those slots anymore? Stellex's thought was they really didn't give a darn about that one way or the other. We want to grow this business, and so we took every slot we could have available for us. And so we are now going to be bringing on 100 407s this year, doubled how many we were originally planning to bring on. So for a total, we're bringing on 120 additional pieces of equipment this year on the trailer side, and then we're going to be bringing on 37. We've already started taking delivery, additional tractors. We run a fleet of about 200 company trucks, and the 37 we're bringing on are completely for replacement. All of the growth our business is doing is with independent contractors, so we don't really plan to expand the assets on the tractor side. The differential for Grammer in the marketplace is really on the trailer side. A tractor doesn't really differentiate us in the marketplace. The trailer certainly can. So that's where the growth is going to be. So for the year, for business, if you think of our business, $115 million business, we're going to be doing $23 million CapEx and investment this year. It's the largest in the history of the company, $19 million on equipment, and then $4 million on maintenance CapEx. So quite a bit of growth in the marketplace. And so working in this type of business, when it's private equity owned, it's all about growth. That's really what the message is. Like I mentioned, the frustration was the lack of growth, and it was because of the lack of availability of equipment and drivers. We're slowly starting to tackle the driver side. We need I came out of a dry van background, and I'm not putting down the driver on the dry van side, but the driver on what we're hiring obviously has to be hazmat certified. Very, very clean DOT record, because if you think about the customers we're servicing, the last thing they want to do is be in the news. Chemical companies will do everything. They'll almost pay up just to make sure that you have a clean CSA score. They look at our CSA scores, are constantly tracking them. And so our challenge is always to find drivers as I mentioned earlier, specifically in the independent contractor side, who have very clean records and who recruit them on to bring those drivers in. The comp on a per mile basis is higher in this segment because obviously we charge a higher rate, but that doesn't mean we don't have competition for that driver. These drivers, as the other gentlemen were mentioning earlier, are still very much in demand. And so the challenge for us this year is to continue to try to keep our retention rates. And in this business, the retention rates are better than what you typically see in dry van. A lot of times you'll hear about over 100% turnover by some of the dry van carriers. We run about 70% retention. Last year we ran at 65%. Our goal is to get it back up to 70 or greater for 2023 because my cost of acquiring a driver right now runs between $4,500 and $5,000 per driver. So I know I need to hire at least 125 this year just for the equipment we're bringing on. And then on top of that, obviously with that churn rate, we know we have to bring more than that on. So one of the changes we made since I've joined the company is we have a very aggressive retention rate incentives for the drivers, and then we actually have a retention department, people who go out to former drivers who no longer want to be on the road, who actually call drivers every single day, talk to the drivers, and constant communication, because a lot of my drivers don't have a home domicile. They're running on the road from their pickup point to their delivery point, sometimes turning that 2 to 3 times a day, other runs 1 time a day, and some guys are out on the road multiple days on loads. And so they don't have that human contact and that feeling of connectivity to the business sometimes. And if you know anything about a driver, if you do something that upsets them and they're 10 hours behind the wheel driving, they're thinking about everything that's upsetting them. And so you really want to make sure that you're doing everything to keep that driver close. So we're working very hard in that area as well. We also do transload. That's a big growth part of our business right now. We're working primarily with the short lines. We are starting to get a dialogue with the CSX to be able to do some things. They actually have their own fleet and assets, but they still at times don't have enough capacity. So we're working with them. And then a lot of the short line railroads who are doing more and more transload. We perform both the transload itself and then also obviously provide the capacity at the transload point to get it primarily to the refinery on the transloads. And then the last piece, we acquired a company back in October of 2022 by the name of LMR, Logistics Management Resources. And LMR plays 100% as a non-asset side of the business. But why this was such a good acquisition, quite honestly, one of the reasons I really wanted to join this business was because we really wanted to break the business up into 3 segments. We have the heavy asset, the 200 tractors, trailers. We have what we call kind of light asset with the independent contractors under our equipment. And then the third piece now having a pure non-asset play. But please don't think of this the way Dean was describing what's going on in the spot market. We really don't play in the spot markets at all because in the industries we're serving, there's not a lot of spot market. There are some opportunities in spot market, but for the most part, what LMR does is true transportation management. We go in, work directly with the chemical manufacturers, and basically become their outsourced supply chain management department for them. Some of the customers, we do just strictly the outsourced management of each and every load within their network. Then we have another subset of customers that we're not only doing that, plus we're negotiating with their carrier baits and negotiating the rates for the carriers that they have. So kind of playing in both. And obviously you can see the natural fit when you have that, kind of capacity out there, and then we have the assets. A big part of our growth plan is to be able to start to integrate, and we're actually doing it already, our capacity into the managed transportation services that LMR is providing to their customers. So I would just sum it up from what we're seeing, because as Tim had mentioned, we all have kind of a unique niche in what we're kind of playing in the marketplace. Our demand continues to be maintained to be very, very high right now. On the 331, the NGL markets, I literally cannot get enough capacity to meet the demand of the customers. Every piece of my equipment's running as best that we can utilize it on a day in and day out basis. What we are seeing though, in especially chemical markets, that is definitely softening somewhat. We're still continuing to run all of our assets, but the demand was so high in 22 that we were getting guarantees from our customers where they were buying capacity on a weekly basis and running those contracts 3 to 6 months. We're still getting some of that, but as these contracts mature and go away, we're continuing to be able to handle the lane, but the days of the guarantees are definitely starting to slow down right now. The way we build our budget for the year is that we will not be continuing to participate with guarantees. If they do come back because capacity really does start to tighten again, that will just be kind of a bonus for us, but we're not counting on that for the year. So just at a high level, that's who Grammer is, and if you have any questions now, I'll be glad to take them. Or obviously, as we mentioned, we'll have a Q&A afterwards. Any questions? All right, thank you very much.
All right, hi, Robert Reagan with Melton Truck Lines, flatbed carrier based out of Tulsa. Here's a quick snapshot of our corporate headquarters. I'll just do a few bullet points about our company, offer some perspectives on what we're seeing in the marketplace, what we saw during the pandemic, and just a variety of things today. We started in '54. It's the largest company of we have a parent company called the Hawthorne Group that has Melton Truck Lines, Melton Logistics, our equipment company, et cetera. About 20 to 22% of our loads originate in or have a final destination in Mexico. To our knowledge, we move more flatbed freight in and out of Mexico than anybody else, and I'll talk more about that today, what commodities we're seeing pick up, nearshoring examples, staffing that we're adding in Mexico. Within that parent corporation, we also have a company called Melton Logistics that does traditional freight brokerage and also non-flatbed brokerage, van, LTL, et cetera. That business last year did about $60 million. We're headquartered in Tulsa, but we have large investments at the U.S.-Mexico border in Laredo and El Paso, fairly good-sized terminal in Birmingham as well. So, as of last week, we owned 1,451 trucks, all company drivers. We don't have independent contractors. About 75% of those trucks were T680s, about a 1.7 to 1 ratio of trailers to tractors. Most of that is to support the international business in and out of Mexico. And you can see the number of drivers, a little over 1,300, and then our office and shop employees, 326. That is just trucking revenues last year, $310 million, non-fuel surcharge trucking. Again, logistics did $60 million on top of that, and then our EBITDA is just shy of $100 million. So that's a little snapshot of our business. So, and I'll skip this one or go through this one pretty quickly. How we've grown historically is just by organic growth, 6 to 8%. Has been what we've tried to do for 20-some years, pandemic years notwithstanding. Have, again, grown organically, have chosen not to do any M&A activity. And you can see if you grow 6 to 8% for 15, 20 years, you wake up one day and you've got a pretty good sized company. Again, we're all flatbed, all company owned equipment. So what have we seen in terms of rates over the last 2 to 3 years, or actually this one starts in 18. First off, I'll say this morning the speakers were discussing the ISM Manufacturing Index. We've gone back 30 years and put our business levels, mainly revenue per truck per week and other business levels, on the same chart as the ISM Manufacturing Index. And the correlation between flatbed results and the ISM, especially if you do a 30-day lag on our results to the ISM, the correlation coefficient is extremely tight. So what I tell our bankers that we borrow money for our trucks from, if you want to know how the flatbed sector is doing, unless you're specialized like in oil and gas or something like that, just look at the ISM. And you can see our rates. 18 was a decent year, basically flat. Start of the pandemic, we had that initial shock. You can see there, it got a little bit below $2 a mile. And starting in the second quarter of March of 2020, much to our great surprise, rates took off and went crazy for the better part of 18 months. That is partly influenced a little bit by Mexico. Again, the volatility is a little bit less down there. The customers are a little more dependent on us. The other thing that has helped us raise these rates recently is we do not have concentration risk. Our largest customer is less than 5% of revenue. So, between the diversification in Mexico, our rates have held up. You can see a little bit of a downtick over the last 2 or 3 months for us, but nothing like some press has reported as far as a collapse of rates. 82 to 84% of our moves are contract related, so we don't do a lot in the spot market. Do 120,000 loads a year, and about 85% are contract, and again, 20-some% are Mexico. I would define what we're experiencing right now, going back 20 plus years, as just a normal winter. Flatbed is seasonal. When the weather's really cold outside, you're not getting a lot of building starts in Minneapolis this time of year. So we're just seeing normal seasonality right now. The other thing I'll comment on that I thought of when the other speakers were discussing, the cost profile, the cost structure of all of our businesses has changed dramatically over the last 18 months. I'm going to talk about driver pay in a little bit, but our drivers, we had to increase their pay 20%. Our trucks and trailers both cost a significant amount more. That's not going to change. Neither one of those are going to go down. So when our sales guys are out there negotiating rates, I remind them, the rates just can't go down. We have a much more expensive business, if you will. It takes a lot more to run this company. So our rates actually in February are trending relatively flat. Again, seasonal. So what else has happened in the last 2 or 3 years? Well, you can see the number of seated trucks we had at the start of the pandemic approaching 1,400. And without getting political, for a variety of reasons, we had drivers leave in droves, a few months after the pandemic got going, even though we had plenty of work for them to do. You can see we hit our low point in 21, and that caused a variety of problems. One is we had so many empty trucks, we had to get rid of them, and obviously we're having to sell them at wholesale deals. We had a lot of overhead sitting against the fence. Our overhead was extremely bloated. We had staffed the business to support a fleet of 1,400, not a little over 1,000. So we were having these wonderful results. These quarters we were just killing it, paying out big bonuses, but we had this quandary. We had all this extra overhead and all these extra people. So what do? Here's your big bonus check, and then here's also a severance check. We chose to keep the staffing levels where they were, just a hiring freeze. And then you can see in the latter part of 21, we enjoyed 13, now 14 consecutive months of seated truck growth. And that has come with great expense. We have raised driver pay since that low point you see there, up 19.5%, just call it 20%. During that time, the average Melton driver last year who drove for us all 12 months made $85,000. That was the average W-2. We had 115 guys make over $100,000, and we'll have more than that this year depending on productivity levels. And then keep in mind, because we're flatbed, our hiring pool is a lot smaller due to the physical nature of the job. We have, I think, 4 or 5 female drivers and not many small guys, so different hiring pool. So what else has happened in the last 3 years? Pandemic gets going. We sell our trucks, by the way, at a 42-month trade cycle, if you're curious what these residual percentages are. And this represents several hundred trucks each year. We have, again, a sister company under the parent organization that we have sales guys selling our trucks throughout the country. A lot of end users, small fleets, leasing companies, dealers buy some as well, depending on how hot the used equipment market is. So we're banging along and just selling trucks at about a 30% residual, which if you go back before 20, that's about 10 percentage points below where we'd like to see a 42-month-old well-maintained asset be sold. Then it just took off and went to levels that I don't think we'll ever see again, or I doubt we ever see. Between the supply chain issues that precluded the smaller fleets from getting new equipment, to the incredible market that they were enjoying that Dean talked about with the spot rates. I mean, these small fleets were paying, and low interest rates. I mean, it drove the price of these trucks up to a crazy amount. So we're getting over a 90% residual. If you look at our financial results, we're talking millions and millions and millions of dollars of gains every month, just like the public guys were enjoying. So that hurts the competition. I mean, they used to buy, or the smaller fleets, they were buying brand new trucks, 0 miles, full warranty, for 8% more than what they bought a 42-month-old truck from us with 6 months of warranty left on it. So now the spot rates have fallen. So their cost structure has changed dramatically too. Now, what's happened recently, it's sort of obvious, it's come down. It's still a decent used equipment market. There, I don't know where the floor is. I know the OEMs are, I don't think, in a position to start selling a bunch of trucks to 100 truck fleets right now, so the demand will still be there. If the freight market improves and we have a soft recession, I think that'll floor and maybe go up a little bit. But we got 450 trucks coming out of the fleet this year, and we'll just see how it goes. But and I'll say this on the OEMs, we're primarily a Kenworth account. I wouldn't want to have their job the last 3 years juggling all these issues that they've shared with us. You couldn't imagine with all their supply chain issues, international issues. We were pleased that we got 80-some% of last year's truck order delivered. Some of us bled into this year. We have another big order on tap for 2023. And as I've said to a couple people here, I don't even really look at this year versus last year anymore on truck orders. It's just, we'll take all the trucks we can get when we can get them right now. So a little bit about our revenue by commodity. You can see steel, in that there's a lot of components within steel: coils, beams, flat, rolled. There's just a lot of end users and industries that consume steel. So that's probably 10 or 15 different things, but steel and steel related products is a big part of it. You see machinery, commercial construction. I will say this, the thing that also I believe helped our rates also is we have, besides the lack of concentration risk, we have very little exposure to residential housing, and we have very little exposure to oil and gas. Those, I think, are the two most volatile industries within the flatbed sector, and we have a few customers, but typically don't play a lot in that space. And by geography, you see domestic, Mexico, and that's revenue, when it be loads. Nearshoring, we've talked about that a little bit today. That takes years, obviously, to really be material to our businesses. You just can't pick up a plant from Taiwan and move it here. But we have a dozen to 15 Mexican nationals who work for us, and they are giving us real-world examples of auto component manufacturers, aerospace. I had them written down, but I didn't bring my notes up here. And several other industries that are really planning and have started the initial plans on moving their operations to Mexico. The country of Mexico is very active in courting all these businesses on the other side of the world as well. So we think the nearshoring will be a real deal. It's just going to take a little while before it gets material. We've hired more Mexican nationals to be positioned more in central Mexico. Most of the manufacturing operations the U.S. companies have right now are in northern Mexico because of the proximity to the border, but some of the big guys now are getting more into central Mexico. So we've hired Querétaro, Mexico City. We've hired employees down there. And then lastly, by segment, again, logistics and the truckload. You can see the breakdown there. Okay.
This has really been a great, view of the industry, and for anyone who's looking at it from the outside, from an equipment perspective, having flatbed, refrigerated, bulk, and I mean, Dean, I'm going to say you're dry van, but I know you're more than that. We do have a really good, cross section here, and maybe a good place to start is on some equipment related issues. And to kind of to follow up, I really appreciate all the introductory comments on this, and that was very helpful. But one thing that kind of stands out is as a theme lately is what's going on in the trailer market in particular. And I believe, Scott, I heard you. I think it was you who said trailers are a real differentiator. And so maybe talk about if you could each talk about the differences that you see in terms of and the long-term trends in trailer to tractor ratios for flatbed, refrigerated, bulk, and dry van. I think there's some interesting nuances there. Maybe start with Robert.
Is this on? Okay. Yeah, again, we maintain a ratio of 1.7 to 1. A lot of flatbed carriers don't have the trailer pools that the van guys have. And again, ours is because of Mexico. Yeah, as far as terms of percentage change in original cost, trailers are up significantly more than the trucks. We currently are on an 11-year trade cycle on the flatbeds. The incremental maintenance cost of an 11 or 12-year-old flatbed is not a lot more than a 8-year-old flatbed. So we never try to really time the market, if you will, on used equipment prices. We've always stuck to 42 months on the trucks, but on the trailers, because of the significant increase in price, we will consider in the future running those trailers out to the 14, 15-year time frame to amortize that increased cost over a longer period of time, because again, the maintenance costs aren't much more.
Thanks. Travis?
Yeah, I mean, in the refrigerated space, trailer costs, like everybody, right? Trailers are up significantly. We are still getting deliveries from last year on trailers. In refrigerated, it's different though, because you can't hold on to trailers as long. The walls will get condensation in them over time, and you can't pull the temperatures depending on what loads that you're hauling. So again, it's about specific where you're running the business. If we have a large candy manufacturer, you're running at 55 degrees, you can use the older equipment. But then if we're running French fries at -10, we can't use the older equipment. So we do the same thing, try to stay on that standardized cycle. And now we're actually using our reefer trailers and putting them into more of the power-only fleet side.
Nice.
Yeah, the only other thing I would add is that
Still no.
still not working. Yeah. The only other thing I would add, and obviously I touched on our fleet and what we're doing with the fleet, is going back to other guys' comments, is our ratio. You can actually easily do the math from the drivers. We run about a 1.6 to 1.7, which in our industry is actually fairly low. And the reason why we have done that is because of our lack of ability to get additional capacity. We've kept our drivers in a much more shorter length of haul, where we don't have to drop and turn with the fleet. So my average length of haul is less than 150 miles right now, and a lot of that is because when you put transload and you do a lot of what we do in the NGL markets, we literally have runs where drivers are turning 5, 6, 7 times a day because the length of haul is so short, but it's just the load and unload time that kind of slows it down. But as we're starting to get the capacity in that I mentioned in 2023, as long as supply chains hold up and the manufacturers deliver, we are starting to go into a strategy of looking for longer length of haul type of business, primarily on the specialty chemical markets, because now that we can start to get that capacity, we see a real opportunity in that, plus the fact that we bought the LMR piece that can do the back haul for us if we go into the forward haul, and now have using the third party to be able to do the back haul for us coming back in. So we anticipate, because of the loosening up on the equipment side, to be able to start to potentially go into markets that we have not been able to serve when capacity was so tight.
Nice. And Dean, do you think is it fair to say that the trailer pool question is primarily a dry van, issue?
Yeah. In particular, dry van, in the last year, shippers have told us that up to 20% and even at the peak, 30% of trailer pools were still loaded, at any one location. So it's effectively reducing the truckload carriers' available capacity significantly. So that has abated somewhat, but it still hasn't gone away. So I think in relation to trailer pools, we're still seeing a sizable amount of trailer pools still loaded being used as temporary storage, albeit getting better.
Yeah. The storage trend is interesting. Maybe that's a good segue to inventory. And to maybe I'll stay with you, Dean, in terms of what's your sense on to put it in baseball terms, what inning are we in of the destock? I think Mazen said earlier, it was May of last year was the first real warning sign. I think that's right. And so we're at least 9 months into it. But yeah, how far do you think we have to go?
I don't have a specific data point other than listening to the large truckload carriers talking about, in their earnings calls, which seem to be unanimous around inventories being run down by the middle of the year and back to normal trade cycles. That's what we're hearing anecdotally from our shipper consortium within our DAT network. So again, no hard data to point to that beyond your own data points that you talked about yesterday on our show.
Yeah, no, that's helpful and consistent with what we would think. Maybe a broader freight question for our asset-based panelists. I appreciate all your comments about volumes already, but curious about your outlook. A little bit more. If maybe you could provide a little bit more detail. Robert, in particular, on the industrial sector. Travis, in terms of anything specific within refrigerated, or when you expect to see those normal improvements in seasonal volumes, and we'll go from there.
In regards to the inventory, we are seeing things settle down finally, but warehouses are still full. In talking with shippers, I brought this up yesterday as we were talking. I was talking with a shipper that their STO orders, so just shipping from one warehouse to another warehouse, is through the roof, and so we're helping them a lot just move product within their own network because the sales are down. We are seeing obviously a change from people buying products to people buying services. In the food industry, that's a lot of what we serve. People eat, and obviously the more people are traveling and doing these things, you see the amount of food back there. For us, it's still stability. But on the dry van side, we're seeing on our logistics side, that's where you're seeing it come down more. The other thing that I would bring up in regards to kind of the shippers and the changes in what they're doing, as we're going through the bid cycles, our strategic customers are doing really good at working with us and keeping us on the freight, working with us on the rates. But below that, we're seeing a lot of pressures on them to drop rates. Specifically, there's a lot more data out there, and so we talked earlier about when I started in the industry, that data was not at everybody's fingertips. Well, now it is. And so we're seeing those cycles. We're seeing shippers go to 3-month, 6-month bid cycles. And that volatility creates issues. We need consistency. We need consistency not only in our asset side, but even on the brokerage side. We want to make sure that we're hauling that freight on a consistent basis. But, as I, flew in from Minneapolis to here, you're seeing all these new warehouses popping up. Supply chains today are very different than they were previously. The amount of third-party warehouses, when you're talking with a Lineage, Americold, New Cold, all the, in the refrigerated space, they're changing all the time. And then the other aspect that we're really facing is, is the transportation controlled by our shipper, or is it controlled by a pickup? And so because we have contractual agreements with a lot of our customers and the rates we're going through the bid cycle, well now some of these shippers, I don't want to call it names, but the cheaper ones are coming in saying, well, I can buy it cheaper. So they're taking the freight back right now because they can get a much lower rate. So that takes that out of our network, and then once this turns, now they'll give it back to that shipper, which then comes back to us, and we'll say, well, now your rate's even higher because we already filled that capacity. And so that's when earlier I said this industry drives me nuts. It's that cycle that shippers carry, like everybody, we do it to ourselves over and over and over again. And it doesn't matter the year, and when we look at all the slides and the economic data, what if a hurricane hits in September, right? Like the weather impact wasn't even talked about. Obviously there's geopolitical and there's other issues, but if a hurricane hits, that throws everything up in the air, right? So there's so many factors, and I think what the pandemic taught everybody, or should have, is how fragile really the supply chain and transportation network is. And right now, it's incumbent on us as carriers and the shippers and everybody to understand we shouldn't be jumping at every little thing. So that's the conversations that I'm having. I'll be down in Food Shippers in a couple of weeks. And that's what really I'm talking with shippers about is, can we just be consistent versus I'm going to drop my rates, and then 6 months from now, I'm not going to honor my rates. I'll let freight will go to the spot market, and then I'll give you a rate increase, and I'll take it back. I mean, if we can have that honest conversation now, or we can have it then. Or we just come to an agreement that let's work together, because he said our costs have went up. When I was on the floor as a customer service rep, you could go through a lot more orders. Right now, we have to have a full tracking team. We have to have a team dedicated to accessorials, tracking detention, tracking lumper fees, tracking all these additional things for the customers. Amazon, good, but bad for us because it set new expectations. I had a CEO of one of our shippers that pulled out his phone and said, I can track the package coming in my house. Why can't I track where my freight is? It's not the same. It's a different supply chain network. Now, we have invested, all of our trucks, all of our trailers have tracking, but broker carriers don't. So now, and again, all of that it's additional costs that people forget about. Things are not free. You have to make sure that you understand that there's a cost to everything that you change.
That's great. Maybe that's a great segue to Robert.
Well,
maybe I'll add to your question. Does the specialization of your assets, of having those specialized trailer types, does that help you to keep rates up more than perhaps the more commoditized dry van market?
Yeah, I think so. If you just look at the number of competitors, obviously the shippers, the volume's less, but we have fewer competitors. And I think, again, it depends on your diversification, et cetera. And I will say this, following up on his comments, I would never, ever, ever wish this on anybody, but hurricanes are really, really good for business. I'll just say that. And as far as the I think we originally were talking a little bit about inventory levels.
Sure.
Yeah, I think unless you're looking at the residential housing sector, which is a little bit different, I think again, the big industrial shippers that we're doing business with, when I hear their expectations for the year, and then when you look at the inventory component of the ISM, I don't think inventory levels are bloated. I mean, business should start to really pick up as it typically does in the second quarter for flatbed.
Yeah. And then the one other longer term demand question I have for you, Robert, is about, to come back to your reshoring comments, and it doesn't, obviously it doesn't take, I agree with you, it takes several years, but at what point do you think it's going to start to gain momentum and start to move the needle a little bit, if you will? It feels like it's been underway for some time now.
Yeah, I think we all did. None of us realized, or at least I certainly didn't, that a majority of our medicine was even manufactured in China when the pandemic got going. So it has been a while that it's been under discussion, but I don't know, Tim, probably 5 years, 4 to 5 years, if I owned a manufacturing operation on that side of the world, from the day that I made the decision to move it to Mexico or the United States, I would guess 4 or 5 year process. The permitting and the other, what I'll call red tape, may be a little bit easier in Mexico than the United States, I don't know, but it's several years, several year project. And then the other thing about macro trends, I get asked a lot about the infrastructure bill that was passed last year, how that's impacting flatbed. Similar, what made me think of it is really for a long time we passed this bill and everyone's thinking we're going to be busy, but really didn't feel anything for a while, but that is just now starting to have some real momentum. And a lot of it is communication towers, cell phone towers, communication infrastructure. We have a project, actually it's loads coming out of Mexico, that's several years and several thousand loads related to the infrastructure bill. And again, it's more communication infrastructure towers.
It's good to hear that's starting up, and that should help moderate that industrial downturn that we're all expecting. So yeah, that's great. Maybe to swing it over back to the supply side, just on equipment supply. We talked a bit about trailers, but obviously everyone cares about tractors as well. And I appreciate the information you've already given, and you've already given a lot. So maybe in terms of equipment, Robert, if you could just talk about, I mean, you did share a lot of the replacements, and maybe just how the market has changed in your mind from a availability perspective of equipment, and then if you could just talk about your longer term growth plans of your fleet.
Yeah, to make sure I understood you, the availability of
New
new
trucks
equipment now,
and how
used-
that's evolved. I know it's been very tight for a while, and it seems to be opening up. It seems like you're getting what you need at this point. Is that fair?
Yeah. I mean, we're fortunate in that we were able to get 80% of our order last year, which allowed us to decommission the trucks we wanted to take out of the fleet and not have to run them longer like a lot of fleets are doing at this time. I anticipate a similar percentage, hopefully maybe a little bit better, being delivered this year. The OEM representatives here can speak to their issues better than I, but we talked to some of the highest levels on both sides, the Freightliner I'm referring to, and it's certainly a long ways away from normal. I'll get an email once a week, and it literally still today will say these are offline because of windshields, and 2 years later. Now, is it better? Yes, but like I said when I was up there, if the OEMs, if we're still having a hard time getting all the trucks we want in the fleets a lot larger than us, that's going to keep the used equipment prices up. Over the I think they won't keep collapsing is a better way to say it.
Yeah, and for a lot of the fleets, it's a profit center. I mean, your slide said it. I mean, our selling our used equipment has become a profit center for the business. And almost every fleet is on allocation, so it's really coming down to what did you order previously, and because we're larger fleets and typically we have consistent orders, we're able to get the trucks. But the other problem that we have outside of even the trucks is our average tractor age is 2.2 years. We had it wasn't even, I think it was 6-month-old truck, went down in November, and they just got the part in last week to fix it. So brand new truck, not in use, right? And that's not unique. I mean, that's consistent across the board. And so until we start to see that supply chain also get rectified and fixed, right? And that's where I think we're probably in a really unique area in that there's going to be pressure on rates and everything to come down, and there's going to probably be capacity out there. However, we can't run at lower rates. Us as bigger fleets and even the smaller fleets, like nobody can afford to operate because of the cost that we've all had to invest into our businesses.
Absolutely. Maybe that's a good segue to come back to Dean and talk about where spot rates will bottom. I think that's obviously one of the big questions on most people's minds. We spend a lot of time wondering about it. I think the data that you showed from FMCSA were really insightful and great in terms of helping us understand the bottoming process, and that's that culling at the margin is what does that. So when do rates bottom?
Barring a catastrophe, something of a seismic event, geopolitically or locally, rates look like they're bottoming out now, dry van in particular. So refrigerators got a ways to go because we're in between seasons. Produce season won't start until April. That's the seasonal effect that has a material impact on reefer and dry rates up until through July 4. So we're a ways away from that seasonal impact. But in dry van, our short-term 35-day forecast have dry van rates bottoming out probably in the next 2 to 3 weeks, and then they'll start that spring inflationary rise that we typically see. Where they're bottoming out, though, is a little bit lower than I expected. I thought, the operating costs for our typical owner-operator long haul running 100,000 miles is about $1.92 a mile today. Diesel's about 70 cents a mile, wages are 61. A lot of the P&L that I base that on is the cost of running my own truck. So the costs are pretty accurate. That's break-even cost. That's not obviously what you want to charge, but that's the break-even cost. And we theorised that spot rates would bottom out at what the basic cost was to run a truck, a small fleet owner-operator truck. So We're not far off that. We're a little bit lower right now with average line haul rates. But the difference this time around, so when I talk about line haul rates of, say, $1.78 as a national average, a lot more carriers in the spot market this year were getting a percentage of the fuel surcharge. Now, we're in building, because in the spot market, it's an all-in rate. It's not passed out like it would be in the contract negotiation. But when we surveyed a lot of our freight network, carriers weren't hauling for the national average, they were hauling for more than that. So we are somewhere at what it, the break-even cost where rates are now, what it costs to run the average long-haul truck. Now, that's a very nuanced subject, because if you've been in this market for a few years and own your own equipment, you can afford to run for a lot less. Can't do it for too long, right? But there's a lot of newer carriers that came in post-July that paid 30 grand per powered unit for insurance as a new entrant, probably paid 3x what they should have for a used truck out of warranty. That's a very different discussion, and I think we talk about 1,000 carriers a month leaving. These are pretty small numbers in the big scheme of things. The vast majority of carriers are doing quite well. Yeah. Right, so we're talking about pretty small numbers when we talk about carriers leaving the industry, but they are carriers that were they made probably the most money in 2020, 2021, and then got hit pretty hard when diesel went north of $5 in early last year.
Yeah. Maybe that's a great segue to kind of come around to the cost side, and maybe this comes back more to the asset-based carriers. Maybe we'll start with Scott in terms of, what are the controllable costs? Where can you take cost out right now in this rough, rate environment, and what's just, it seems like drivers and equipment are sort of the ones that can't change. But yeah, can you?
Yeah, I mean, for us right now, quite honestly, there's a couple things we're doing on the leverage side to pull cost out, and it's typical of a lot of businesses. We are looking at all of our SG&A cost within the business wherever we can. Driver costs are very difficult. Right now, with our independent contractors, we primarily pay them on a percentage of the load. Typically between 68 to 70% of the load goes to the independent contractor. The challenge I have around that is when my commercial team goes out and negotiates a rate increase, which were very favorable last year, this year, still very good, but not at the levels they were in 2022. That percentage goes right to the independent contractor. And then with the IC, they also get 100% of the fuel. So whatever fuel surcharge, we get from the customer goes right to the independent contractor. So a couple of the changes we are making on certain lanes, we're going to go, and we are introducing at the end of this quarter, is to start to flat rate the driver. Instead of paying them on a percentage, we're giving them a flat rate. Now the market's still going to dictate what that driver makes, and we're very cognizant of that. But what we're trying to do is to be able to capture, when that increase goes into effect, a greater percentage of that margin going back to the company than going directly to the driver, who's still going to get, we're not looking to take any pay away from the driver. It's just that when the increase comes in, we want to capture a larger percentage of that. The other areas around fuel, the new drivers we're bringing in this year, we are going to start to take a percentage of that fuel surcharge for the independent contractor and negotiate that with them in the new contracts for the new drivers we're onboarding. Our existing drivers are going to be grandfathered in, and we're not going to touch them because it's such a volatile issue with the independent contractor is fuel. So we know we have to kind of tread lightly on that, but we're just going to try to be as prudent as we can to capture as much margin as possible. The other area, and Dean touched on it a little bit at the end of his comments around insurance cost, we unfortunately had two catastrophic accidents in 2022 before I joined the company. And what that did to our rates, and we negotiate in October is when we did our renewals, we had a significant increase in our liability rates because of those two accidents. And the ironic part of it is that our driver was not even close to 100% at fault. And I don't want to get into all the details, but the way the insurance companies view that, obviously we become a higher level, a much more higher liability. So even from our primary rates and then everything that we have on the tower, everything went up exponentially. And unfortunately, you just can't pass those rates on to your customers. They're not going to pay them. So it is just a margin challenge for us on the insurance side that we're going to be competing against all year. So we have invested heavily on what we're doing with our driver safety programs. the way we're vetting new drivers coming in. And again, we recruit from a much smaller pool, but really looking at what that driver's safety rating is, because again, not only are customers looking at it, but our insurance providers are looking at that as well. So we're getting, it's a challenge. That's all I can say is as far as what the insurance cost has done to our business, but it's one we're managing through as best that we can right now.
Thanks. And Travis? And maybe Robert, too, same question.
Yeah, I mean, it's still business, right? It's people, process, product. And you can't, with what we have going on, you can't take out that much cost anymore. You just can't. In regards to insurance, and I feel like we were named from our insurance company for our group top carrier, and our rates still went up, right? Now, they didn't go up nearly what a lot of our competitors went up, but they still went up. And so, every truck has drive cam, all the things we have, a guy who's focused on just reviewing tape. And if you want to be a part of a horror movie, sit in those meetings, because it's not a movie, it's real life and what you're seeing out on the road. And I mean, it'll make you sick. We hire, it used to be you would have somebody who oversaw safety. Well, now it's vice president of risk, because you're just trying to minimize the risk that you have. And so in regards to taking cost out, it's working with your people, your process, and just making sure you're dialed into your business. Obviously, reducing your deadhead, trying to work with your core customers, keeping the trucks full. There's a lot of just little things. It's getting back to the basics, the blocking and tackling of business, and making sure you're doing the right things. But I'm always a believer, Sam, the owner of the company, is a believer. It takes money to make money. So you have to invest into the equipment. You have to invest in your people. You have to invest into, our driver lounges, everything that we do. You can't look at it from a short term, which is hard, right? When you start seeing your profits really tighten up and you have a lot of capital sitting out there. But at the end of the day, over the long haul, if you invest properly and you spend the money, you'll get the return.
Robert, same cost question?
Yeah, I would agree. I mean, if you look at the major cost components of the business, wages, equipment, training, there's only so much you can take out, really. You want to have an attitude amongst your employees that we don't want any wasteful spending, but you could add a lot of that stuff up, and getting 2% increased out of asset utilization would be a lot more money to us. But as far as the insurance market is concerned, I think everyone knows it got hard about 3 or 4 years ago. We have not had an insurance carrier write a check for $1 on our behalf in 5 or 6 years, yet our premiums were up in the neighborhood of 60%, give or take, and I'm talking more excess coverage, not primary. So in response, what we did is like a lot of big fleets, you don't like to do it, but we cut our tower by about 45%, and the tower is up there pretty good. I mean, for a while you could buy 25x50 for $60,000, and so everybody was doing it, but that all got really expensive. But last year in 2022, the market for the most part, I wouldn't say it was good, but it was less crummy. So for a comparable amount of premium, we were able to take our tower back up a fair amount last year, not to where it was before. And that's from what the conversations I've had with some other large fleets, that's what a lot of us did last year, is just get our risk towers back up to where they were.
Is it fair to say that the nuclear verdicts and the higher insurance costs, are these helping you guys sell dedicated to shippers, and maybe the higher amplitudes of the rate cycles as well? Is that happening?
I don't see the connection myself on nuclear verdicts to.
Well, in terms of outsourcing, they're not owning the equipment themselves.
Oh, I see what you're saying. Yeah, I'd have to check. I mean, that would make some sense if I was the CFO of a shipper and one of my trucks got into a wreck that was $40 million settlement. I'd strongly consider, putting that risk on someone else.
I will say that's why we started the power only. because, for our trailer being out there, that's less risk, using somebody else's authority,
That's interesting. Yeah.
right?
Yeah. And the only thing I'd add to that, these two incidents we had in 2022, you hear about the nuclear verdicts. They're calling it social inflation, and we're doing everything we can in both of those incidents to keep it out of a jury, because once you put it into a jury pool, and the amount that juries are awarding in these nuclear verdicts are just out of this world. So we went to the top of the tower on one of ours, and the other one we were able to get it down quite substantially. But the entire mission in both of those situations was to keep it out of the courts, come to a settlement, even though you kind of had to hold your nose, quite honestly, because the one of them, we had such a small percentage of the issue, but you still are paying significantly. But you're much better off keeping it out of the courts, because these verdicts that are coming in just don't even align close to what the compensation really should be in some of these cases.
Yeah.
And the last comment on insurance is the excess market got so high and so difficult for us over 3 or 4 years that I think it brought back some entrants into that marketplace that had left a few years ago. If you recall, AIG had a piece of all of our towers. They pulled back significantly from trucking with the underwriting profitability, even with the nuclear verdicts. I think you're seeing some of that capacity come back in, or at least that's what happened last year.
And one other thing on the shipper, and I don't know if you guys see this in the brokerage side, but because these carriers can't afford those higher premiums, they tend to get cheap insurance, which doesn't cover a lot of products. If you actually read the policies, the amount of exclusions and all of that. And so we're having to invest more in that side too, in watching what coverage do these carriers have. But it just opens up a lot more. It opens up us to risk. It opens up, obviously, the public out there. So there's definitely a lot of issues with insurance in that there's not standard coverages, or there's things that are missing and gaps that cause issues. We're trying to do the right things, and then and then that's how he can get a cheaper rate, and then that's where you start getting into other issues.
Yeah.
And the last comment,
Yeah, go for it.
but kind of go back to Travis's point about cameras in the trucks. What we do with our trucks is everything is forward facing right now, and then we do both side rear view mirrors, so we have back facing on that side as well. The big thing that when we went through our renegotiation back in October, and especially with the independent contractors, is the inward facing cameras, and is that to your benefit or not to your benefit, and how it affects your rates. There's a real push for us to do inward facing. At least at our company, the independent contractor is dead set against having a camera looking in at he or her as they're driving. The thing that we're just trying to start to populate with our drivers is it's an event-driven camera coming on when the driver's going down the road. If the driver's going down the road and there's no event, there's nobody watching that driver. But I totally respect the driver. I wouldn't want somebody watching me with at least the thought that somebody's watching me the whole time I'm driving. So really to get the independent contractors to buy into that has been very challenging. But as we slowly start making our way into the year and start talking about renewal, at least for our company, that's becoming more and more of a topic of discussion about having that camera not only externally facing, but also potentially internally facing to the driver as well.
Well, thanks. I want to open up to the audience for any questions out there. I see one in the back. Microphone's coming. I do have a couple more, but if anybody else has questions, feel free.
Robert, quick question for you. My name's Jim Gavigan. I heard you say that you trade your trucks on a 42-month trade cycle,
Yes.
and that when you trade them, that you have 6 months left on the existing factory warranty. And I'm just wondering if you've seen that impact the residual value of that asset when you go sell it to that secondary buyer with that 6-month warranty.
And I'll have to qualify because I need my truck sales guys here. Some of it's transferable, some of it isn't. It depends on a few factors. But yeah, I think that does help if you're able to pass along some type of a warranty coverage to the secondary buyer. You know, he knows his is catastrophic maintenance expense anyway would likely be limited for a period of time.
Thank you. And I guess the other question of the day, since we talked a lot about electric vehicles in the morning, I'm wondering how you gentlemen are doing in terms of your assessment of where electric fits in with your respective fleets. Thank you.
First off, I'll say those presentations were interesting. They've all built some really cool companies. In our case, with our average length of haul being 1,000 miles, you'd first have to overcome the infrastructure issue, which I think would be something that would take a period of time. You have the weight issue of the battery. You have the overall cost of ownership. What will these things cost because the grants won't be there forever? What's the residual value? So I will long be retired and on a golf course, I think, before Melton's business profile will have them. But that doesn't mean it won't happen someday. It's just, if we had a local delivery, it makes sense. But again, long haul, over the road, Class 8 trucking companies, especially with longer lengths of haul, it's going to be a long time.
Oh, the only thing, I'm sorry, I was just the only thing I would say again, because so many of our drivers are independent contractors, the only interesting thing that, not only, but one interesting kind of change that we're starting to see, we do a lot of business with BP. They are starting to invest in what they call the Midwest Hydrogen Corridor. And you might have started to read about that, but they have approached us. We have our first meeting coming up, and they want to know if we want to be a part of this corridor that they're going to be opening up through the Midwest using hydrogen-powered vehicles. And by doing that, if we will invest in the equipment as far as the tractor is concerned, coming back at us would be that density that's going to be running along that corridor, since obviously we haul that type of product in exchange for investing and being part of the kind of cutting edge as they look to get participants in that corridor. So we're looking at other things all of the time and where the incentives might be. But again, because we're pushing so hard to not have to get into the tractor side of the equation, even though obviously we do have a fleet of 200 plus. But something like that, these opportunistic opportunities are the type of things that we're seeing more than anything right now.
Yeah, the couple comments I would have is just, supply chains change too much for it to work for our application. I think there's a lot of great application for it, and I think we saw school buses and, in the ports, and there is good application for it. For most of the, what we do, what's going to impact us is, I forget which slide where, I think it was Convoy said that, 35% of the trucks are empty, and reducing that. That's actually going to help more, and that's where we're going to see from the businesses that we work with. I just don't see the. I'll hopefully be on the golf course with you retired before we get to that point.
Kenny?
Yeah, so very interesting panel, guys. Travis, you mentioned that you had a 6-month truck or a 6-month-old truck that was down because of you couldn't get a part for it. And I think throughout the the supply chain shortage, it wasn't just the new side of the business, but it was the ability to get those aftermarket parts. So if all of you could maybe just touch on how it's improved and to the extent there are still aftermarket challenges, what are the parts that your trucks are sitting around waiting for? Thanks.
I talked with our VP of maintenance, yesterday, kind of about this, and our prices are up, roughly 20% on parts across the board. Availability is a little bit better, but it's still not great. And so overall, it continues to be a challenge. And the other, the interesting fact, so this VP of maintenance, me and him actually worked at the previous trucking company I was at. He was also there. You look at the change in equipment today, and a truck today is not the same as it was back in 2007. And so same thing with their cars, same with everything. And so there's just a lot more complexity to things. And so when you have things go down,
it's a big issue. So like as a generalization, what goes, bad, I wouldn't have a specific part, but just overall, there's challenges across the board.
Yeah, and I would agree with that, the same thing. The only thing I would add, there's two things within our business. Number one, the availability of parts is still a challenge, but the price for all of the aftermarket parts have gone up. And when we look at our maintenance CapEx and what's happening with just maintenance cost in general, not just the CapEx side of it, we are definitely seeing increases in the cost of the parts to keep the trucks moving. The second piece, when I was talking about recruiting independent contractors into the business, one of the challenges we have, because of the pumping systems on the trailers, there is a piece of equipment called a hydro pack that you have to mount to the tractor to be able to extract and input the product in and out of the trailers. It's about a $10,000 piece of equipment that the driver has to have to be able to run in our fleet. Not only do we have to overcome that price or that cost hurdle of getting the driver on to purchase the hydro pack, but what we saw, especially in the tail end of 22, the ability to even source the hydro pack. We were sourcing all over the country just to be able to get them, to get the drivers, up and running. So you recruit a driver in, you get them through the onboarding cycle, and you're getting them ready to run. And then there was this whole variable around getting this hydro pack, not only to source, but then get it mounted onto his truck so that we'd be able to have the driver run, because without it, the driver's useless for us, because you can't obviously either onboard the product into the trailer or the tank or extract it at the point of destination. So that's slowly starting to ease up. We're starting to be able to source them a little bit easier than we had been in the fourth quarter, but we have our eyes on it all the time, because you just don't know when this is going to bubble up again, quite honestly. So it kind of is one of those things you're constantly keeping your eyes on.
All right, I'll throw it back out to the audience in a second. Sorry, Dean.
I was just going to say, from the owner-operator perspective, Kenny, it's things like lubricant. Like, I don't get the opportunity to buy oil in bulk like you guys would. So I'm trying to buy 5-gallon pails of Shell Rotella 15W40. I still can't buy a 5-gallon pail because in the when the ice storm hit during the polar vortex, the chemicals, the factories that produced the chemicals for the lubricants limited the supply of oil. So I still can't buy the right quantity of oil. But the secondary part of it is because of the labour shortages and the shortage of technicians, a lot of owner-operators, including myself, have had to do their own maintenance. So normally you'd send that out to get somebody to do it. I'm under a truck on a weekend doing oil changes because A, it costs double to get it done if I could find someone that was taking a customer, and B, if they had a decent mechanic that actually knew what they were talking about or looking at. That's a really big issue for a lot of small fleets today.
Maybe one longer term question, and I'll kick it. We have a little bit of time, but maybe just a yes or no for everyone. I apologize, I haven't prepared you guys for this one, but the EPA 2027 standards are likely to raise the cost of a Class 8 tractor by roughly $20,000. Yes or no question. Do you think there's going to be a pre-buy in the years preceding that?
No, and I don't think the OEMs would allow it if we tried.
All right.
What he said.
Dean, what do you think?
I'm good.
All right. Let's come down to Jeff here in the front. You got a question? Mr. Kaufman?
So I while I'm walking up to Jeff with the microphone, I did want to ask Dean a question, because in looking at his bio, he spent a lot of time in the insurance industry, and we didn't have a chance, and maybe he's so far removed from it, but is there is it, as long as there's nuclear verdicts, we're never going to see the end of higher insurance rates, or how does this all resolve itself?
It's a good question. There's a big chasm between managing risk and managing the cost of insurance. So real risk is what causes accidents to happen. Having run a long-haul insurance book for a large company, it's very old school underwriting. They look at the outcome of an accident, not what caused it. So you've got, and on top of that, you've got a lot more data. It's a lot more discoverability. And as we saw at a recent event that we were at, right, Robert, there's a real hesitancy to document anything in your systems that could point to what caused an event. And if you don't know what causes your event, it's very hard to actually prevent them. So there's actually a big divide that's going on in the market right now. And it seems like the insurance underwriters are looking at less information, and what they're looking at is the wrong information. Because, I mean, there's one big underwriter that's using telematics to underwrite. I know from a data point of view, looking at actuarial data, what causes accidents is not the radius of operation, but the time of day the driving occurs. Risk by the hour is actually how you should underwrite a long-haul trucking business. There's only one large insurance company I know that uses ELD data to underwrite, to manage accident costs. So basically, it's a very old-school business that seems reticent to change at the moment.
Last thing I'll say on that is at a macro level, when you're talking about nuclear verdicts ending and rates going down, some things can be done at the federal level, but meaningful tort reforms at the state level, and it's such a heavy lift. I mean, we've had minor victories, but the trial attorney's lobby is so powerful, and I could get into 20 minutes on this subject, but I wish I had a rosier picture, but I think it's going to be difficult for the foreseeable future considering what we're up against.
Jeff?
Yeah, just an observation. I mean, when I hear what everybody's talking about, we'll get whatever trucks we can get, and we've got trucks in our fleet that we can't use because they're lacking parts and the supply chain's still tight and we're all on allocation. It feels like despite the drop in spot rates that Dean was talking about, we've got very tight capacity right now. So I guess my question is, if we made 300,000 trucks in a year, normally we would all be saying, oh, we're adding 3 or 4% to industry capacity. But it sounds to me like if we produce 300,000 trucks, we're not adding much to capacity at all. So I guess my question is, Dean, you talked about we're losing 1,000 carriers per month, I think. But I don't see any trucks sitting in auction yards waiting to be sold. If I look at Ryder, they don't have a lot of trucks in inventory to sell. So I guess my question is there a certain amount of capacity that's being tied up right now by some of these supply chain issues? And does that present a risk 6 months from now, 9 months from now, as the supply chain starts to heal and we start getting trucks out there, that we could have capacity, even though you're saying spot rates are showing signs of turning right now, is that because we're still capacity restricted, and as these supply chain issues ease, could we see more capacity come into the market that we're not thinking about later this year?
Yeah, I think it's very nuanced. Sorry, I'll let the other guys talk to the contract side of the market, but on the spot side of the market, there is definitely an overcapacity of trucks for the volume of freight moving in the spot market, right? But there's fairly small numbers in the big scheme of things. But I think the bigger issue is more in the contract market. My analysis of the market shows that capacity is still tight, much tighter in the contract freight market compared to the spot market. But as to whether it's loosening or softening, I'm not sure how you guys see it.
No, I mean, the freight volumes are down, right? So, I mean, it is loose. The problem we have is the supply chain. So I'll give you an example. We had a driver that had a coolant hose leak, and so he's an hour and a half late to Walmart to deliver. So what happens from that is we have to reschedule the load for 2 weeks because they're booked out for 2 weeks, even though, I mean, there's not as much freight, but for some reason they're booked up for 2 weeks. They fine our shipper 5% of the invoice. And that's the other thing in the industry that's the Walmart impact is that's a profit center for them. Is every shipper, they are fining for everything. You can't show up early, you can't show up late. If you show up early, they're not going to say we won't take you, they'll take you, and then they fine our shipper. And so the utilization of equipment is really poor. And then even like for our own fleet, right now to fill our trucks, you try to stay within your network. We have a terminal obviously in Minnesota, Illinois, down in Dallas, and then we go out to Idaho and then PA and Atlanta. So that's kind of our corridors. We're having to take
freight outside of that to make sure that our trucks continue to move, right? Because, you're trying to, well, that's not efficient, because again, that gets back to that 35% of trucks that are moving with empty. And I would assume that 35% is actually higher right now. There's a lot more trucks that are sitting. And so you guys are fortunate you don't have to deal with the Americolds, the UNFIs, the Walmarts, the Sam Clubs of the world. But they make us inefficient, which is why, it gets back to the trailer manufacturers. Congratulations. It's going to make you guys happy, because we have to get more trailers, because we're going to have to drop, because then that becomes, more efficient and better. But I would say you're spot on in that we are in a loose capacity market, but we're completely inefficient. So any sort of tightness, and we're right back to where we were. And then that's the fragile nature of our supply chain.
One more point on that, Jeff. I talked to one of the larger refrigerator truckload carriers last month, and I'll quote, "Because our drivers have never made so much money, they've never wanted to be home as much." So our available driver pool is shrinking, and our available trucks for dispatch is growing. So it's a separate issue it's not a 1-for-1 ratio, I guess is what I'm saying. And maybe that flows on because driver wages are pretty good, and younger generations want to be home more.
That is true. That is true.
Well, I'll open up for any final questions, but I think it's been a great discussion. Any last ones? Going once, going twice? Yeah, go for it.
I'll ask one more, if I may. We haven't talked about the driver shortage. It was all caps in neon, 18 months ago, and we have a for-hire survey that's actually said that there's it's basically saying there's no driver shortage at this point. And granted, there's always going to be tightness, but maybe if you could just compare and contrast, go across the panel, compare and contrast, how hard it was to find drivers, a year ago, 18 months ago, what's it like today? And then, maybe also just touch on mechanics, while we're talking about labor for the trucking industry. Thanks.
Good one.
Again, I'll lead off on this one. And again, I know we're much more niched than maybe what Travis and Robert are dealing with, but it has loosened a little bit. But I think Dean's point is one. It just resonated me when he said the driver wanting to be home. Trying to find drivers today that are willing to stay out 2, 3, 4 days, and I know some guys have drivers that are out much longer than that. That is becoming very, very difficult for us to do, and we're almost getting the inverse where drivers are now saying, if you can't get me home either nightly or every other night, they won't drive for us any longer. We actually just lost some drivers, and I'm going to be going up this weekend. We're having a driver meeting with a crew in Salina, Ohio, and already prepping me for what these drivers are going to be really pushing me on. And obviously they're looking for more comp, no surprise there, but it's the quality of life issues, which we address. And I think Travis hit it very well about what you try to do to make sure that there is a quality of life factor for the drivers, and we truly want to do that for them. But the demands continue to escalate, and then that pool of drivers who are willing to get into, especially with what we're hauling, because a lot of the products we haul can literally kill people. It's unfortunate, but when you see what happened up in Ohio and the ramifications of a derailment, we have some of those same risks with the products that we're hauling as well. And there's a lot of people who just, and drivers in general, who just don't want to haul and have that kind of exposure. So there's a lot of challenges to it. But again, I wasn't here for a good, or at Grammer for a good portion of 2022, but just talking to my recruiting team and my retention team, while still very, very difficult, it was even more difficult in 22 compared to what it is right now in early 23.
Yeah, I mean, it's gotten easier. There's no doubt. During the pandemic, you had the driving schools shut down, so that was an issue, right? So that took out some availability. All three of us have to have a little bit more specialized driver than a dry van. Not that the dry van drivers aren't important, but for us, they have to be monitoring temp and, are you cycling or continuous on the reefer unit? And then obviously what you guys do is even more specialized. But just the drive, I mean, you're losing the people who might drive.
And so, like as example, I don't know how many people in here have even driven a semi, but I know, I grew up in a town of 360 people, so I drove a semi, but there's no way I was ever gonna drive over the road. But you can't even drive till you're 21, and then you have a company like ours, you have to have a year's experience for like that's one of the things we do to make sure to keep our premiums in check. And so because you're losing those kids. I mean, again, I grew up in a farm community. Some of those kids still kids. They're my age that I graduated with. They still live around home, and a lot of those small farms have been gobbled up by the large farms. And so you would have those as possible drivers. It's a good wage coming right out of high school. But you lose them. And then they go to the trades and they can make, especially now, $40,000, $50,000, $60,000. Why are you going to go drive? You're just not. And so if you can't start it, when they're younger and make it a career where it's attractive to where they want to come drive, which is why we talk about driver lounges and, flying drivers home, or, we're doing everything we can to make it an attractive position. But really it gets back to Congress addressing the fact that you can't do interstate. I know, Warner's talked about a lot, they're on the border of Iowa and Nebraska, and they can't have, a lot of farm kids in Nebraska, but they can't even go into Iowa, right? Like they could really increase their pool, Warner specific. Derek Leathers has talked about that to Congress multiple times. And so I would say we're in a period, again, getting back to some drivers wanting to stay home, but there's availability out there of drivers. But a lot of the drivers that we're seeing come through, it's scary. I talked to a friend who has a trucking company. They have the inward-facing cameras. And driver, ton of experience, 3 months with the company. This was the third company this driver had been with. And driving down the road, sets a cruise, goes back into the cab, does something back there, comes back, and starts driving again. So immediate termination, right? And so when they sat down to talk to him, he literally is like, "What's the big deal?" And they're like, "I'm guessing this isn't the first time you've done this?" "No, I've done this my whole life." Like those are the old cowboys that have done it. But then, I'll watch video of some of our drivers, and it's like, how did you even get a CDL? You can't back a truck up into a dock. And so there's big challenges. And it's only going to get worse because those farmers, the truck drivers that are now aging and starting to get out, there is not that backfill. My kids are, they're farm kids. My 12-year-old backs up, I have a 1-ton truck with a 36-foot horse trailer. He backs that up the driveway, like he can drive. He's not going to be a truck driver, right? That's not a career I'm going to send him towards. And so what is that population that we're going to go after? That's what, as trucking companies, we have to figure out where we're going to get that capacity.
So I have one quick question. So Robert and Scott are return attendee or return speakers. So first of all, I appreciate you being back. But Scott, you were the recipient of a gift from Ken. Would you give us a quick little breakdown on that?
Yeah,
previously?
So I had a chance to be one of the keynote speakers back in 2018, right after we sold a company called Dicom Transportation. It was really just about the evolution of taking a business that was bought by private equity and taking it from the start to finish. And so at the end of it, and it was really my first introduction to ACT and the whole, everything that Ken put into it. And he didn't know anything about me. I didn't know anything really about them. It was a learning experience. And so, like, one of the things, I always call myself, I'm a railroad geek. I just like the history of railroading and everything that railroading represents. And I've never worked for a railroad, but as a little kid, all the way through, I've just always followed railroading. So I come off the stage, and he shakes my hand, thanks me so much, and he hands me a railroad lantern that I still have in my office today. And I'm like, and he said, we just look at each other. I'm like, "Hey, did you know this about me and all that?" He said, "No." He says, "But I just thought it was a really nice gift and I wanted to give it to you." And it was a legitimate, it was a real true railroad lantern, antique railroad lantern. And it just meant so much to me. So the first time I met Ian and he asked me if I wanted to, do the panel, I told him that story and I said, it sounds goofy, but it's like stuck with me my whole life. And it just represents what this whole organization's all about and how personal he made it when I did this. And you go to a lot of tracks, you go to a lot of conferences, and that was just something for me personally. It's just always stuck with me, and I just really respect your organization for doing something like that. So just hats off to you guys for what you do. It's great.
Thank you. Thank you.
So bad news. I don't spend my weekends at auctions. So any future speakers, sorry.
Just give another hand to our panel, please. Thank you, gentlemen.